All right, everyone, a warm welcome to this video on risk management. Okay, if you're someone that's just blowing your trading account, or you keep blowing your trading accounts and you're never understanding where do I place my stop loss, where do I place my take profit, how much do I place on the trade to make sure I'm not risking too much in my account. Okay, if you're taking certain lot sizes and positions, or how much do I put on a trade to make sure I don't blow my account. These are very, very important lessons that you have to understand and learn. And when I first started trading, it took me to lose £25,000 before the penny dropped. And I learned, luckily, from someone who used to trade at Goldman Sachs, okay? I learned his risk management strategy and how the banks do it, the hedge fund traders. And they don't gamble. They don't make up random stop losses. They use a lot of information, which I'm going to show you in this video. And I'm going to give you the spreadsheet that I learned how to use. And I never blew my trading account again in 10 years, okay? And I've taught this to thousands of my members, okay? And they never blow their accounts. So by the end of this video, I promise you now, your trading will never be the same again, and you'll learn how to manage your risk. Okay, guys? Enjoy. All right, everyone, warm welcome to today's video. In this video, I'll be showing you how to never, ever blow your trading account again using this spreadsheet. Okay, I've given this spreadsheet to thousands of my members over the years, and honestly, the feedback I get, because it helps people to never make the same basic mistakes that people unfortunately make in the beginning, or even if you've been trading for a while. If you don't grasp the ideas behind risk management, you literally end up losing money to the markets unnecessarily. Okay, so whenever we get into a trade, I don't care if you're trading currencies like Euro USD or USD JPY, or you're trading stock market indices like the S&P 500, or you're trading commodities like gold, for an example. When we place trades in a market, this spreadsheet is going to teach you how to put the price of the asset you're trading, anything, Euro USD. I'm going to teach you about volatility, because if you're a day trader, a weekly trader, or a monthly trader, you have to understand how much does something fluctuate over that time period historically to know where to place your stop loss. So if you've been placing random stop losses 10 pips, 20 pips away from your entry price, and you keep blowing your trading account, I'm going to show you exactly why, because you don't even know how far to place your stop loss to know where to give the market the room it needs to fluctuate over the time period you're trading. Then this spreadsheet, when you're going to calculate how much you want to risk of your account on a certain trade, is going to spit out an answer to how much you need to be trading per pip or per point in the stock market. And then it's going to give you your lot size automatically. So when you get this spreadsheet, you'll never blow your trading account again. I can promise you that right now. Okay. However, what we need to start off by making clear is ATR volatility is what the professionals use. I was taught this by someone who worked in Goldman Sachs, and when I learned it, I was like, fucking hell, I wish I knew this when I first started trading. So stop losses are not random. Okay, so let's say we're looking at trading the currency markets, Euro USD, or we want to trade the US dollar against the Japanese yen. We have to understand historically how much does the Euro USD exchange rate fluctuate on a daily basis, a weekly basis, or a monthly basis before we get into a trade. Because if we don't understand the daily fluctuations, for an example, if you're trying to day trade, you don't know where to place your stop loss, and then you don't know where to place your take profit to give yourself at least a 2-to-1 or 3-to-1 risk to reward that ensures your accounts grow, even if you get some trades wrong. Okay, now stay with me, because this ATR volatility actually gives you your lot size, and I'll show you how. Let's say you want to trade Euro USD. Did you understand that the data inside the spreadsheet calculates how much does Euro USD fluctuate on a daily basis over the past 1 week, 1 month, 3 months, 1 year, 2 years? And you can get the average of how much it's fluctuating by, which is 0.61%. So if you're trying to day trade Euro USD, you need to understand that immediately before you get into a trade, your stop loss has to be 0.61% to give it the daily fluctuation room without hitting your stop loss, which means around 70 pips. So if you've been trying to day trade Euro USD and you keep getting caught out on your 10 pip, 20 pip stop loss, well, you automatically know why. Because this data, what you're using, is the numbers historically going back 10 years. We're not guessing, we're not making up this data. This is the hard numbers that the professional traders at investment banks, hedge funds, this is what they do. They use computational methods. They're not gambling, okay? Then if you want to trade Euro USD over a weekly time period, no problem. It fluctuates on average by 1.4%. So you automatically have to understand, all right, my stop loss has got to be 1.4% to give it the weekly room to fluctuate, okay, without me getting stopped out. So your stop loss would have to be 154 pips as an example. Or if you're monthly trading, catching big swings, what I do, fundamental trends, you got to have a stop loss at least 2.64%, okay? This is where you have to have your stop losses. So if you've, number one, kept getting hit out of trades really early and you've never understood how to calculate where to place your stop loss, well, there you go. Unfortunately, no one's shown you how to calculate the numbers for yourself, okay? Now, different exchange rates have different fluctuations, because look, if I go and I show you, for an example, how much does a dollar fluctuate against the Japanese yen, it's very different. On a daily basis, 1.919%. Very different to Euro USD. So if I'm trying to day trade USD JPY, let's say we want to sell this currency pair, I've got to have the stop loss at 1.19%. That's 175 pips minimum if I'm trying to day trade stop loss before I get into where to take my take profits, for an example. See? That's a lot more than a Euro USD of 0.6%. Okay, so different assets fluctuate differently. If you're trying to catch USD JPY over weekly time frame, 2.5%, monthly time frame, 4.25%, which means if I'm trying to swing trade this currency pair, my stop loss has to be around here. 628 pips, okay? Now, the reason why I'm showing you this is because once you understand the fluctuations, where you place your stop loss, the spreadsheet's going to tell you automatically, right? So let's come in here and have a look. Let's say we're trading Euro USD. The exchange rate today is at 1.09740. Okay, so let's go back over here. 1.09740. Okay, the average volatility on a daily basis is 0.61%, I think we had. Okay, so all the yellow tabs, you fill out the number, and then you come down here, stop loss ATR, 0.61%, right? Okay, so on the chart, we're looking at it, stop loss should be 1.10406. Boom, 1.10409, pretty much bang on the money. So the spreadsheet, based on the volatility, is going to work out automatically where to place my stop loss, okay? Now, why this is important, all right, is because when you're taking a trade in your trading account, the pip value, how much you're putting on the trade, is dependent on the stop loss, and I'll show you how. Let's say you have a £25,000 account, okay? For example, it could be anything. It could be a 5,000 account. You need to determine how much you want to risk on each trade you take. You don't want to risk too much because you could blow your account. And this is something else people don't realize. I risk 5%, okay? So if I'm trading a 100 grand account, for an example, and I'm risking 5%, the maximum I can afford to lose on a trade is 5 grand. I'm never going to risk more than 5K. How much is my lot size to make sure I don't lose more than 5K? Well, this spreadsheet is going to tell you your pip value is going to be 74 pounds per pip. How? Because 5,000 divided by the stop loss of 67 pips is telling me that's how much I'm allowed to put on the trade. Because if it goes against me by 67 pips, boom, I only lose my 5%. So if I'm taking the weekly example of ATR volatility for Euro USD or monthly, so let's go back over here. If you're trading Euro USD on a monthly basis, 2.64%, right? 2.64%. You can see here, the stop loss is saying 1.12638, right? So all I have to do on my spreadsheet is come over here and type in 2.64. 2.64. Boom. It's telling me my stop loss has to be 290 pips. Yep, 290 pips, bang on the money. Telling me my pip value now, if I want to be trading this exchange rate, for an example, has to be $17.26 per pip. Okay, a big difference from the first example, was $70 per pip. Okay, so notice how the spreadsheet's telling me if I'm taking a pip value of $17 and it goes against my 290, then I'm going to lose 5K. But look, you can do this with any account size. Let's say you're only trading a 2,000 unbalance. It's going to tell you straight away, you can only take a trade with 35 pence per pip. Okay, if you want to only risk 100, which is 5% of 2,000. All right. And it's going to tell you if you want to get a risk to reward in your favor of at least 3 to 1, where to place your take profit price as well. which is going to give you a profit of 300. So you're risking 100 to make 300. And look, it tells you the lot value, whether you're trading standard lots, mini lots, micro lots, or even unit sizes. It gives you the answer. So you're not going to ever place random trades with random lot sizes, not realizing that you're risking too much. And more importantly, you need to stick to the risk reward in your favor. Because look, as an example, let's say you have an account, 10,000 balance. You want to risk 20% of your account on a trade, which means you're risking 2,000 of your 10,000 balance. And if you're trying to get a 3-to-1 risk reward, well, that basically means that you're trying to make $6,000 profit and you're risking 2,000, okay? But look how powerful risk to reward is. You need to always try to aim for at least a 3-to-1 in your favor, which basically means if I took 10 trades, win one, lose one, win one, lose one, win, lose, win, lose, win, lose, and every time I win a trade, I'm making 6,000, but every time I lose a trade, I'm losing 2,000. Look, I have 10,000, I win a trade, I make 6,000. I lose a trade, I lose 2,000 on my 6,000, I'm down to 14. And look, even if I only win 50% of my trades, I'm still making a 200% return on my money. Why? Because the moment you win one trade, you have to lose 3 in a row just to break even. Okay? Now, obviously, if you risk less in your trading account, you're going to make less profit compared to the first example. Okay? But you save your account from losing trades. So, an example, you're risking 15%. That means you're risking 1,500 of your 10,000, trying to make 4.5. You take 10 trades exactly the same, win, lose, you're still making 150% on your money. Do you see the power of risk to reward? Imagine taking 10 trades, getting half right and doubling your money still. That's the power of risk to reward. You need to make sure when you're trading, you're giving yourself at least a 2-to-1 or even a 3-to-1 risk to reward. Because the moment you win one trade, you got to lose 3 in a row just to break even. You win 2-3 trades in a row, your account's gone. You're making money because now you got to lose 9 trades to break even. Okay, I trade around 5%, so obviously I don't want to risk too much of my account. I'm trading quite big amounts of money, and I don't want to be risking all my money in the markets and doing stupid things. Okay, so this is where you need to come down to around 5%. Okay, if you want to trade professionally. I know people who trading professional firms, they're trading like 2% risk, but they're trading huge accounts. Okay. And investors are not happy to take huge risks. So this is very important. Use a risk to reward of 3-to-1. Now this spreadsheet has already set up all the risk rewards of 3-to-1 already. Okay. So if you're getting into a currency trade, or you want to trade the stock market index like the S&P 500, or you'd have to come over here and say, all right, if I'm trading the S&P 500, how much does it fluctuate on a monthly basis? Okay, 6.25%. So if I'm going to swing trade it, I come over here and I put 6.25%. 6.25%. And what's the current price of the stock market today? We can have a look here for the S&P 500. 5736. 5736. That's the price. All right, perfect. I know my stop loss has to be 359 points. Let's check. What was it? 6.25%. 6.25%. Around 350 pips. Okay, I can't get it bang on the money because I can't get the exact price, but you can see the stop loss is telling you how many pips to place your stop loss. And then if I'm trading a 3-to-1 risk to reward, it's going to tell me the stop loss price, which is saying, for an example, over here, 5377. You can see here, pretty much bang on the money around the stop loss price. The take profit is going to tell me the 3-to-1 risk reward going obviously in the favor of where I want to be buying. But more importantly, put your account balance in here. How much you want to risk. I don't know, let's say you got a 10,000 account and you're trying to risk 10% per trade. No problem. You can do £2.79 per pip on that trade. All right, automatically, you know your lot size, you know how much to place on the trade. This spreadsheet will stop you doing stupid things. Okay, now, unfortunately, most people don't have the analysis of how much does something fluctuate. I got all the analysis, all of the stock markets, all of the USD currency pairs, all of the metals. If you're trading gold, for an example, do you know how much gold fluctuates by? Again, on a weekly basis or on a daily basis, if you're trying to day trade gold, your stop loss has to be 1.2%. Okay, so let's go to the spreadsheet and let's have a look. If you're trying to trade gold today, which is breaking record highs because interest rates are going down, okay, we can come over here and we can see, all right, I want to trade gold. If I want to buy gold today, what's the price of gold currently? Let's have a look. Gold's price today is 2643. 2643 point, what was it? 0.51. Right. How much is the weekly volatility of gold? If I want to get into a gold trade, well, straight away, the spreadsheet's telling me on average, it fluctuates on a daily basis. Sorry, if I'm day trading, 1.2%. No problem. Let's have a look at where the stop loss has to be. 1.2%. Straight away, stop loss has to be 3,172 pips. Points means the same thing, right? If I want to buy this today, 1.2%. There you go. 3,181 pips, points, whatever you want to call it. There you go. If you've been trying to day trade gold and you're trying to have a 100 pip stop loss, it moves on average 3,000 pips a day. Now you know why you keep blowing your trading account. Especially if you're trying to take that position and you're not realizing how much you have to place on the trade. So again, if you're trading a 10,000 account and you want to risk 10%, your lot size has to be 0.32, 32 pence, 32 cents. Otherwise, if you're trying to do a pound a point, you don't even realize you're not risking 10%. You're risking 30% of your account if it goes to that level. Okay, so we're not guessing in these markets. We need data to know where to place a stop loss, where to place your take profits automatically. And this spreadsheet gives it to you. So in that example over here, when we looked at the S&P 500 for an example, all right, and it was telling us where to place our stop loss, it's saying our take profit is 6811, okay, which is our 3-to-1 risk reward, which would mean an 18% climb higher. Let's have a look. 6811. Okay, so let's go back to the S&P just to prove to you how accurate this spreadsheet is. From today's price, let's just get up here. We can just type it in. What's the price saying? 6811. 6811.50. 18.75%, which is a 3-to-1 risk to reward of your stop loss being 6%. So guys, I don't care what you're trading, day trade, weekly trade, monthly trade, it doesn't matter. But what you do need to understand, how much is something fluctuating every day? Because based on how much something fluctuates, that will tell you how far your stop loss has to be. And then how far your stop loss has to be is what's being used to calculate your lot size. Do you understand? A lot of people aren't getting this and they don't understand that. The lot size you put on a trade, how much you're placing per pip, is not a random number. You have to know where to place your stop loss, and then you basically, once you know how much of your account you're going to risk, okay, I'm going to risk 5%, 10%. And once you understand how much that 10% value is, let's say here, for an example, you're trading a 5,000 account and you're risking 10%. Well, you know, I'm risking 500, but the lot size I take is depending on where the stop loss is, because you're dividing 500 by the stop loss to get your pip value. Okay, I'm trading $1.73. If I'm trading standard lots, I'm doing 0.17 lots. If I have a mini lot account, I'm doing 1.73 mini lots. If I'm doing micro lots, I'm taking 17.26 micro lots. It all equals the same amount here. Even if you're trading units, look, some brokers, you have to trade the unit size. No problem. Let's say we're gonna trade Euro USD, and I want to sell. Okay, let's just type in paper trading for an example, right? Look, if I want to paper trade Euro USD as an example, look, notice here you have to put the unit sizes in. So if you don't understand how much the unit size is, you may lose a lot of money. No problem. The spreadsheet tells you here. If I'm selling the currency, okay, 17,258. Type it in here, 17,258. There you go. Stop loss. Okay, you just type in a stop loss number over here, which over here was telling you 1.12. It's going to tell you everything. You can do it automatically. Okay. 637. And then you can place your take profit wherever you want. Okay. Listen, I lost £25,000 on a trade before when I was younger, before I had this education. And when I got this education, I never blew my trading account again. And I've taught so many people this education, and it's changed their trading. So if you're tired of blowing your trading account and you really want to fucking get out of that habit, you need this information. So this spreadsheet is going to give everything for you. Okay. And the ATR volatility data, you don't have to update it that much. Okay. And I've got separate videos explaining how to do that, how to get this data, how to update it, and how to know where to place your stop losses. Remember, guys, don't pick random stop losses. You're just gambling. Professionals don't gamble. They use historical data to understand where prices move historically, so they choose their stop losses. And then they take profits and not random prices. Remember, they're aiming for their 3-to-1 risk to reward. Okay, and your lot size is automatically being calculated. Okay, once you have this education, you got all the ATR numbers here in the middle of the spreadsheet. You never blow your trading account again. Happy days. And I'll be so happy to help you in your trading journey. All right, guys. So if this video has added some value, please like, comment, subscribe. Click the link below the video to get the spreadsheet. It's going to take you over to Telegram. You're going to get an automatic download, and I'm going to give you daily educational updates on the markets, which I've been giving to thousands of my members, okay? And they really do use this to their benefits, okay? I can just literally show you quickly some of the results of members sending me through. Just the other day, look, October the 4th, this member made 5,000 profit on their accounts. Look at their lot sizes. They're not taking big lots. Why? They're using the risk management. Okay, when members here are taking these trades, look at their lot sizes. These are not huge lots, 25 grand account, but look at the lot size. Why are they making these profits? Why is Dan making 3,500? Look at the lot sizes. They're not big lots, but they're trading big accounts. They're using the risk management. This will save you guys, I promise you, okay? Anyway, enjoy, get the spreadsheet, and hopefully I'll trade with you soon.